All right, let's dive into something that's really got me thinking lately.
Sounds good.
Market makers.
Oh, yeah, they're everywhere.
I mean, we hear the term thrown around a lot, right?
Mm-hmm.
Especially when we talk about scalping.
Absolutely. They're kind of like the backbone of how scalping even works, wouldn't you say?
Totally. And that's why I think it's so crucial to understand how they operate, especially if you're interested in strategies like, well, the one we're diving into today, from Find Your Own Scalping Strategy.
It's kind of like learning the rules of the road before you get behind the wheel of a race car. You can't really master the track without understanding the forces that shape it.
Exactly. So for anyone who's maybe new to this whole world, how would you explain what a market maker actually does? I've heard the analogy of a bustling marketplace.
Right. Okay, so picture this. A bustling market, but instead of vegetables and fruits, it's stocks or currencies being traded.
Okay, I can see it. Lots of shouting, lots of chaos, but also somehow things are moving.
Exactly. Now, those market makers, they're like the vendors in this crazy market. Always there, always ready to buy or sell, making sure the whole system never grinds to a halt.
So they're the ones ensuring there's always someone to buy when you want to sell,
Yeah.
and vice versa.
Exactly. They're all about keeping those wheels greased, ensuring things flow smoothly. That's what we call liquidity. And here's the thing.
So it can't just be about keeping things running for the good of the market, right?
Right. Just like any business, they're in it to make a profit. Think of it like this. That markup a street vendor puts on their goods. Well, the market maker has something similar. The bid-ask spread. That tiny difference between the price they're buying at and the price they're selling at.
Okay, so that's how they get their cut. It makes sense, but I've always wondered, especially with all this talk about scalping and find your own scalping strategy, how do they profit from those tiny price movements? We're talking fractions of a cent sometimes, right?
Absolutely. And this is where it gets really interesting. One of the tactics this guide delves into is flipping. Imagine a street vendor again, right? They hear a rumor that oranges are about to skyrocket in price.
Okay, so they quickly buy up all the oranges from nearby vendors before the price jumps.
You got it. And then they turn around and sell those same oranges at a higher price when the demand surges. Boom. Profit.
That's essentially what market makers do with flipping, right?
Yeah.
They buy low and sell high,
Yeah.
capitalizing on these tiny price differences that most people barely even notice.
Exactly. They're playing a volume game. They make their money on the sheer quantity of trades, squeezing profits from those minuscule price fluctuations.
It's a fascinating, if slightly ruthless, way to make a living. Okay, so we've got this image of these super fast operators constantly buying and selling, profiting from these micro movements. But what happens when something big hits the market? You know, like a massive news announcement or a sudden economic shift.
Then things get really strategic.
Yeah.
Imagine our vendor friend again. If suddenly everyone wants oranges, they need to protect themselves, right?
So maybe they raise their prices. Or maybe they limit how much they're willing to sell until things calm down.
You got it. And market makers do something similar. When big news hits, they widen that gap. We talked about the bid-ask spread. It's a way to manage their risk during those volatile periods.
Okay, so it's like they're building a buffer zone until the dust settles.
Exactly. And this is where things get particularly interesting for someone who wants to get into scalping. Knowing how market makers react to news, to volatility, it's all part of understanding the playing field.
I can already see where you're going with this. If we know they're more cautious during those times, could we potentially use that to our advantage?
Now you're thinking like a trader. But before we get into all that, let's talk about another tool in the market maker's arsenal, something your guide calls hidden orders.
Oh, yes.
Yes.
Those definitely sounded a bit cloak and dagger, even to me. Like, what are they hiding?
Right. It sounds very mysterious, doesn't it? Imagine being able to place an order to buy or sell a stock, but you get to choose whether everyone else can see it or not.
Okay, so it's like having a secret weapon up your sleeve, ready to be deployed strategically. And just like any good strategist, I'm guessing market makers don't spread themselves too thin. They can't be masters of every single stock or asset out there, right?
You're absolutely right. Not all financial instruments are created equal in the eyes of a market maker. They usually gravitate towards assets that are highly liquid and have those nice, narrow bid-ask spreads we talked about. It's all about maximizing efficiency and minimizing risk, just like any savvy investor.
So it's a bit like a high-stakes game of poker. They're choosing their battles carefully, playing the odds, but on a much faster and grander scale.
Exactly. And speaking of high stakes, have you come across the term liquidity trap in your guide?
Oh, yes. That's where things started to feel like a detective novel, like we're on the trail of some elusive criminal mastermind.
Right. It's all about understanding those traps, those situations designed to entice traders to make a move so the market maker can profit from the predictable outcome. It's like setting a trap in the market.
So how do we even begin to spot these so-called liquidity traps? What should we be looking for?
Picture this, you're looking at a chart, right? And you see this big cluster of orders all bunched up around a key level.
Okay, like a traffic jam on the price chart.
Exactly. Now, these stacked orders can be a bit of a siren song for traders, especially those looking for a quick entry or exit.
So it's like they're drawn in, thinking it's a sign of strength or weakness, depending on whether it's a buy or sell cluster.
Precisely. But just when they think they're about to cash in,
The rug gets pulled out.
sometimes, literally. Remember the URUSD example from the guide?
Yeah, with the big sell orders just below that crucial 1.2000 level.
Exactly. Price surges up, touches those orders, and then boom, nosedives. That sudden reversal, classic liquidity trap.
Ouch. Anyone who's expecting a breakout is left holding the bag.
Exactly. And that's why volume analysis is so crucial. Think of it like this. A whisper in a crowded room. Easy to ignore. But a sudden shout, everyone notices.
So when we see a sudden, noticeable spike in volume right when the price hits those stacked orders, that's our cue to pay attention.
Ding, ding, ding. It often means a lot of traders are getting caught in the trap, adding fuel to that sudden reversal.
Fascinating. It's like the market's giving us these little tells, these subtle hints that something's not quite right.
Exactly. And these traps, they can work on both sides of the market. Remember those buy orders we talked about, clustered above a support level?
Right, so it could look like a bounce is coming.
But then, instead of bouncing, the price just keeps sinking. Another trap sprung. It's all about recognizing these patterns.
I have to admit, it can feel overwhelming sometimes, like trying to outsmart a chess grandmaster.
You and me both. But that's where learning to decode the market maker's language comes in handy. And one of the most powerful tools we have, order book monitoring.
Order book monitoring. Okay, so we're not just glancing at it. We're talking about really diving deep into the details.
Think of it like this. You're trying to understand a conversation in a completely foreign language. At first, you only pick up a few words here and there. But as you listen more, as you start to recognize the patterns, you start to grasp the meaning.
So we're essentially becoming fluent in market maker, trying to anticipate their moves before they make them.
It's not about predicting the future with 100% certainty. That's impossible. But by analyzing the order book, looking for imbalances, we get a feel for the market's underlying sentiment.
Order book imbalances. Okay, let's break that down for a second. What does that actually mean?
Remember those stacked orders we talked about? Well, an imbalance happens when there's a significant difference between the buy and sell orders at a particular price level.
So if we see a huge wall of buy orders with only a few sell orders opposite it, that suggests strong buying pressure.
Exactly. It's like a tug of war, and the buyers are clearly winning. On the flip side, if there are way more sell orders than buy orders at a certain price, it suggests
That the sellers are in control and a price drop might be coming.
right. Order book imbalances give us this snapshot of the supply and demand at different price levels. It's a bit like having X-ray vision into the market's intentions.
Okay, that makes sense. And then there's market depth data. That sounds even more complex.
It's actually pretty straightforward once you get the hang of it. Imagine being able to see not just the current bid and asked prices, but all the hidden orders waiting in the wings.
Okay, so it's like peeking behind the curtain, seeing the full picture instead of just the surface.
Exactly. Let's say you're looking at a stock and the current bid is $49.95, the ask is $50. With market depth, you might discover a huge EE buy order hiding just below the surface, say at $49.90.
So even though the current bid is higher, this hidden order tells us there's a big buyer waiting to scoop up shares if the price dips just a tiny bit more.
Exactly. It's all about understanding the potential support or resistance at those key levels.
That's amazing. It's like having a secret weapon to navigate these choppy waters. But we can't forget volume profiles, right? They were mentioned in the guide, too.
Ah, yes. Volume profiles. They're like a secret decoder ring, helping us see the story behind those price movements.
So instead of just seeing the price go up or down, we can see where the real action was, where buyers and sellers were most active.
Imagine a bar chart. Each bar represents a price level. The height of the bar, that's the volume traded at that price. Areas with taller bars, that's where the real action was, where the big players are duking it out.
So those high volume areas could represent key support or resistance levels, the levels where the market really struggled to break through.
Precisely. By analyzing these profiles, we can identify those crucial price points where there was significant activity in the past, which might give us clues about future price action.
Okay, so we've got order book imbalances, market depth data, and volume profiles. But can we really predict a market maker's next move?
Predicting the future is a fool's errand, my friend. But remember, market makers are creatures of habit. They have certain patterns they tend to follow.
Like telltale signs, footprints we can follow.
Exactly. And one of the biggest giveaways is their consistency. Market makers, they're like those reliable friends who are always up for a chat no matter what time of day or night it is.
They're always there, present in the market.
Exactly. Always ready to buy or sell. They maintain that tight spread, remember? It's how they keep things moving, how they profit from those tiny, tiny price differences. So if you see a trader who's consistently offering the best prices with very little space between their buy and sell orders,
There's a good chance we're looking at a market maker.
it's a good bet. Another thing, they're incredibly quick to adapt to news, to sudden changes in the market.
It's almost like they have insider information sometimes.
Well, they do have to stay informed to manage their risk, which brings me to another point. Market makers generally don't like to hold large positions overnight.
They're not in it for the long haul.
Remember, their main goal is to facilitate trading, not to make those long-term bets on market direction. So if you see someone closing out their positions like clockwork as the market closes,
That could be another sign we're dealing with a market maker.
it's definitely something to watch for. But, before we get too caught up in trying to outmaneuver the market makers,
We can't forget about one of the most important aspects of trading, right? Especially with fast-paced strategies like scalping.
absolutely, risk management. It's like even the most skilled chefs wouldn't cook without understanding food safety first.
So what are some practical tips?
Yeah.
Especially for those who are just starting out with scalping.
First things first. Accepting that losses are inevitable. It's not about avoiding losses altogether. It's about managing them effectively.
And one of the tools we have for that is a stop-loss order, right?
Exactly. It's like an emergency brake for your trades, automatically limiting your losses if a trade goes against you. But it's not just about preventing losses. It's also about protecting your profits. And that's where realistic profit targets come in.
Which is especially important for scalping, right? Since we're dealing with those smaller profit margins.
Exactly. It's easy to get caught up in chasing those big wins, but greed can be a trader's downfall. Having those realistic profit targets helps you stay disciplined, helps you stick to your plan.
It's about staying rational, not letting your emotions dictate your decisions. This has been an amazing deep dive. We've covered so much ground, from understanding what market makers are to recognizing their tactics and even potentially using their behavior to our advantage.
And we've only scratched the surface. There's a whole world of trading out there to explore, so many different strategies and nuances. It's a lifelong journey of learning and adapting.
It's like we've been given this backstage pass to this incredible, fast-paced financial ecosystem.
Yeah.
But one thing's for sure, continuous learning is key. What works today might not work tomorrow, right?
Absolutely. And in this world of algorithms and high-frequency trading, never underestimate the importance of the human element.
Human element.
Emotional intelligence, discipline, critical thinking, those are essential skills for any trader, no matter your experience level.
So it's not just about the numbers. It's about staying calm under pressure, making rational decisions.
Precisely. Trading, it's a marathon, not a sprint.
Yeah.
Focus on building that solid foundation of knowledge, developing a strategy that aligns with your risk tolerance, and don't be afraid to reach out to mentors or seek guidance when you need it.
Wise words to end on. For all our listeners out there, remember, this is just the beginning of your trading journey. Embrace the challenge, never stop learning, and who knows, maybe you'll be the one sharing your market wisdom on a future deep dive. Until next time.